Hello and welcome to Portfolio Matters, weekly markets checklist week 214. But before we get into it, Richard will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Another busy week, I'm afraid. Lots going on, all change. Now, before we get going, some technical news. Unfortunately, Richard is on his laptop, which seems to have forgotten his camera. So we'll do this week without any visuals from Richard. Okay, so the news. Well, it's been volatile in markets. We had a big sell-off in technology stocks, which appears to have abated overnight as Trump has calmed markets by saying that he's close to a deal with Iran. Great progress has been made. Um, we have just made a great settlement of the war with Iran, he said. The Iranians are less positive, saying that they have made progress towards a deal, but final settlement is not close because of excessive demands by the US. So, once again, just before the weekend, Trump is calming the markets. It remains to be seen how close to a deal we actually are. There was a big sell-off in precious metals. Gold fell almost 8%. Platinum was down over 10%, as was silver. The ECB has reacted to the rise in inflation caused by the war in Iran and rising energy prices by raising rates. It raised interest rates by 25 basis points to 2.4%. Other central banks are likely to follow. Anthropic has filed for a 1 trillion plus IPO. OpenAI has filed for an 850 billion IPO. And SpaceX has confirmed it will be filing for a 1.8 trillion IPO. There's a lot of new equity issuance coming onto the market. Nvidia has announced it will launch a PC chip, the RTX Spark, to compete with Intel and AMD, and that aims to bring AI computing to your laptop or PC. And Trump is threatening to restart the trade war by imposing tariffs of between 10% and 12.5% on 60 trading partners after a forced labor-related trade investigation, i.e., any old excuse to get tariffs back on. So some charts related to the news. Well, equities have had a bad couple of weeks. This chart is a couple of days old, and since then we've had a little bounce. We'll take you through the all the data in due course. The Kospi, the South Korean index, fell 15% in 3 trading days before stabilizing. But when you look at the chart over the last year, well, it's had similar falls and kept on rising, and it's still up 166%. We now have a surge in companies' mega IPOs, and that will drain some liquidity from the market in the coming months. And as you know, we are skeptical about whether AI can justify the huge increases in share prices over the past few years. And this chart shows that AI is having an effect in its massively increased the number of apps being launched. But when you actually look at the number of apps being used, they've fallen. So how much of the increase in output that AI has enabled is actually resulting in useful products? Question mark. And the markets are now pricing in roughly 2 Fed rate hikes in the coming year. So Kevin Walsh remains under pressure from Donald Trump to cut interest rates to 1% or less, but markets think that he will, like the ECB, end up raising rates as inflation rises. This will appeal to all Richard's prejudices in that the new chairman of the Fed, Kevin Walsh, has expressed a preference for using trimmed mean PCE inflation instead of core PCE inflation, which was Jerome Powell's favoured metric, to set monetary policy. And you can see the two here. Unsurprisingly, trimmed mean PCE inflation gives a more benign outlook for US inflation than
Yeah, so
does
it's
core.
trimmed mean on top of hedonic adjustments, Keith. It's like everything we possibly could do to pretend that we don't have an inflation problem.
Exact. And finally, it's the World Cup. England are third favourites.
Wow.
Markets, are they efficient? Question mark. Okay, and on to war news. Well, all you need to know is that as of today, the straits remain closed, although the US has been operating a system of secret transits by which tankers have been going through Omani coastal waters at night with their transponders turned off. Now, Energy Aspects estimates that up to 3 million barrels a day has been transiting the straits in recent weeks. And the Apache helicopter, which was shot down earlier in the week, was apparently taking part in the missions to provide air cover for these secret transits. So, one of the reasons why the oil price has failed to shoot to the moon, as we were expecting, is that more oil is leaking out of the straits than we'd previously thought. Over the past couple of weeks, there has been exchanges of fire, various attacks relate as the Israel has attacked Lebanon. All this. Pause, have a read. So last night we had Donald Trump saying that an agreement is very close. Progress appears to have been made, according to The Economist this morning, but the two sides do remain apart. And when Donald Trump has said that the Ayatollah has signed the agreement, that appears not to be true. So there is a pattern of the president talking up peace prospects, and that has been going on now for well over 2 months. Back in March, very good and productive conversations with the Iranians, said Donald Trump. Pause, have a read. But it's true, over that time, Brent has drifted lower rather than heading much higher, as we and a lot of people had been expecting. The US is saying that they have kept the Strait of Hormuz open for transit, and hundreds of ships have transited in the last couple of months. And the way the US has been doing that is by using a route close to the Omani coast. Now, Energy Aspect estimates up to 3 million barrels a day has been successfully exported via this route in recent weeks. I think that's probably an overestimate, but certainly a substantial amount has got through. I would say at least 1.5. Now, all of that could end if the Iranians successfully manage to interdict or blow up one of these. And as evidence that of this trade, the FT has had an article showing lots of ship-to-ship transfers happening in the Gulf of Oman. So what appears to be happening is that the same tankers are going back and forth through Omani waters, transferring, carrying oil, and then when they get through, they transfer that oil to larger tankers for onward transit to the rest of the world. There has been continued attacks. Now, the UK Maritime Trade Operations website have reported 3 attacks in the Gulf of Oman. It's not clear who these attacks are by because CENTCOM, that's the US, has also reported three successful strikes on ships during the past week, one of which killed three Indian sailors and led to protest by the Indian government. And it's not clear whether the two are the same, but it's unlikely that the US would be attacking ships in the Omani Gulf close to the Omani coast. I'd expect theirs to be close to the Iranian coast. And separately, Iraq is exporting some oil, we're estimating around 50,000 barrels a day by truck overland through Syria. So supply chains are rejigging, but obviously that is not a lot of oil in a global context. Even accounting for oil, Iranian oil coming through the Straits and non-Iranian oil coming through the Straits, well, we're still drawing down inventories at a pace, 5 million barrels a day. That's a lot.
Let's go back to that chart, Keith. I was listening to, is it Adam Rosenswag?
Yes.
Yesterday on a podcast he gave, and talking about demand destruction. And so demand destruction is on this chart is measured at 5 million barrels, roughly speaking. And he was saying that's not true, that the way demand is measured is via refinery output. And what that means is that refinery output has dropped by 5 million barrels a day. But refinery output has dropped because Middle Eastern, Asian refineries can't get oil and they're shutting down. And China has stopped exporting all refined petroleum products, which means that Chinese refineries have also shut down. So the demand destruction number is much too high, was his point.
Yes, I totally agree with that. I don't think we've had anywhere near 5 million barrels of day of demand destruction.
Yeah.
And we'll get onto this, but it appears that the reason oil prices have not shot to the moon is that China has much larger stocks of refined products than we'd previously thought and is releasing them. Now, the Institute for the Study of War have released this statement, which I thought was spot on. The Iranian regime is attempting to use force and the threat of force to establish a strategic reality in which any Israeli or US attack on Iranian proxy or partner would result in a large-scale conflict which would seek to impose significant economic and political costs on Israel and the United States. This was after, so Trump forced Israel to stop attacking Hezbollah in Lebanon. So, to my to my point of view, Iran is in tactical and strategic control of this conflict, and I don't see them wanting to end unless it's very much on their terms.
I would agree with that, Keith.
So this is the latest from the prediction markets. When will traffic through the states of Hormuz return to normal? Now, this was yesterday, and they were saying not before November. This is today, saying actually 50-50 chance by September. So odds have come in, but markets are still expecting this to continue for another 3 months. Freight costs have doubled since the start of the war. All this is inflationary. Fertilizer flows are half what they were. That's an astonishing number. That's monthly exports of fertilizer. But I found this absolutely amazing. Despite the fact that fertilizer flows have halved, fertilizer prices have completely unwound all their war premium. Now, it appears that this is because farmers went on a buyer's strike. They refused to buy fertilizer at higher prices, and instead they planted different crops, in particular legumes. Now, that is bad for grain yields in the coming year, although corn prices in the US have also fallen from their highs.
Mm.
It appears the market thinks that all the disruption from the war in Iran can be managed. And another thing that's going to affect farmers in the coming year is that it seems we are likely to have an El Nino event, which leads to drought and will further pressurize crop yields. And the media has been warning of a super El Nino event. So the force of the El Nino I was reading could be the worst in 140 years. Whether that is true or not, I'm not sure. And a status report on the war in Iran. So, in recent days, the US and Israel have attacked sites in Iran. Those are the blue dots, quite a lot of them, I would say. And Iran has retaliated by attacking mainly US bases in Jordan, Kuwait, and Bahrain. Now, Trump called off strikes overnight, but the background has been a continuing low level conflict within the, in quotation marks, ceasefire. But 9 million barrels a day remains shut in the Gulf. This is from BCA Research, and they must be reporting only official traffic or traffic that can be monitored going through the straits, because we know a lot has been more has been going through under US escort with their transponders turned off. And essentially, we have no visibility on how big those flows have been. So they're reporting no improving trend in traffic. Transit costs have fallen together with Brent and fertilizer prices. That's good news. Richard's point, refinery runs in China have fallen. Now, presumably that's because they're refusing to pay up or they can't get hold of the oil. US strategic reserves are falling. I've put in the blue line, and they're falling actually at quite a rate. But they will, at this rate, you could draw down for most of the rest of the year. Gasoline prices in the US remain high, and we'll talk about the effect on inflation later, but inflation is rising in the US. Diesel prices similar. They remain high in the US. Now, these are European jet fuel prices, and they're well down from their highs, but they're near double their January levels, and they have bounced back in recent weeks. Global air traffic remains totally unaffected. Actually, there are more flights than there were last year by about 1%. Fertilizer prices, astonishingly, have come right back down to earth, as we talked about. So, in summary, the double blockade remains in place but is increasingly leaky. Everyone is finding ways round the blockades. So, energy aspects estimated up to 3 million barrels a day leaking out. But we're still seeing record disruption to the global oil system. It's an unstable stalemate. We are drawing down inventories. That can't last forever. So, why haven't oil prices spiked? Well, over the past couple of weeks, the consensus seems to have settled on the role of China. So, China appears to be propping up the market with inventories that's both of refined products and of crude. So its imports have massively dropped. So previously it was importing 12.5 million barrels a day, and that's dropped to 8. So you've seen a fall of that's 4.5 million barrels. That's one hell of a lot. Notice, by the way, the relentless trend upwards in China's oil imports as the economy continues to grow. So when we talk about the medium-term outlook for oil demand, seem to be solidly intact, growing demand, despite China actually leading the world in renewables and the transition to EVs. So what this chart is saying is that as the Chinese economy continues to tick along just fine, China must be releasing inventories to the value of at least 4 million barrels a day. And China's crude inventories actually rose at the start of the year, which is astonishing. They're now drawing down. So China is helping to minimize the disruption from the war in Iran by maximizing domestic oil drilling, curbing fuel imports, and it's issued extra quotas for Russian and Iranian oil. But it also can't draw down its inventories forever. So at some stage, if this continues, we still expect oil prices to spike as inventories start to run out. And hurrah, Richard is back.
Thank goodness.
Yes, thank goodness. Right. Economic news. So we've had this morning UK GDP data for April, and that was poor as expected. The economy fell 0.1% in April and grew only 1.2% year on year. Consumer borrowing was stable. UK construction PMI fell to new lows of 38.2. So the UK construction industry is struggling with weak demand in a higher interest rate environment and higher input costs. Indeed, job postings index continues to fall. The UK job market is not doing well. The ECB raised rates by 25 basis points to 1.4% and warned that it could raise them again within the next year. And it also raised its inflation forecast for 26 and 27 due to the impact of the Iran war. They said that the inflationary impulse was strong and persistent. Inflation in the Eurozone rose to 3.2% in May. Core was at 2.5. April retail sales were weak at minus 0.4% month on month, 1% year on year. So the EU consumer ain't doing so well. US inflation came in at 0.5% month on month in May. That is a big inflationary impulse, actually, 4.2% year on year. So inflation in the US much worse than in the UK and in the EU. Core was 0.2% month on month, 2.9% year on year. Non-farm payrolls beat expectations by a margin, coming in at plus 172,000 in May. So the jobs market, in fact, the whole of the US economy appears to be strengthening, not weakening. Earnings growth was stable at 3.4%, which you'll notice is below inflation. So real earnings growth negative, not good for Donald Trump. JOLTS job openings also rose quite sharply to 7.62 million. And the ISM manufacturing and services PMIs both rose, both decent, both beat expectations. So the US economy doing just fine. Market news. Well, hurrah! The S&P Dow Jones Index decided not to change its inclusion rules for SpaceX. So SpaceX will not be joining the S&P 500 for a year, and only then if it has posted a profit in its most recent quarter, i.e., frankly, it won't be joining the S&P 500 for years, if at all. AI stocks fell after Broadcom beat both earnings and revenue forecasts, but its future forecast revenues disappointed, and that was enough to spark a sell-off in the whole tech complex. OPEC Plus announced 188,000 production increase in July. Whether they can actually get it out is another matter. So equity markets were generally weak, but bounced yesterday after Trump's news. Nasdaq down 4.5% of the past couple of weeks. S&P down 2.5%. Bitcoin down 14%. Energy markets weak, amazingly. So Brent down 5.4% over the past couple of weeks. Coal up 11% on Indonesian export controls. Industrial commodities also weak. Aluminium down 4%. Copper down 1%. Iron ore down 7%. Nickel down 7%. Tin down 6%. Precious metals terrible. Gold down 7%, silver down 12%, platinum down 12%, bond yields stable. So UK 2-year yield up to 4.4%, but the 10-year stable at around 4.9, 30-year around 5.6. So some charts relating to the market. The Broadcom shares fell sharply, and that fall came in despite the company beating both revenue and earnings expectations. The Kospi fell 15% in 3 sessions. And talking about the impact of AI, well, white collar roles are being hit. So banks are aiming to cut a lot of jobs. HSBC aiming to cut 20,000 roles, around 10% of its workforce, over the next 3 to 5 years. So good for banks, bad for white collar employees. More on that later. And onto equities, Richard.
Thanks, Keith. Generally speaking, a bad week for equities as well. So the FTSE All World down 2.5%, sorry, 2.3%. All share down 1.1%. Stocks Europe down 0.6%. S&P 500 2.5% down. Russell pretty much unchanged. Nasdaq down 4.3, Hang Seng down 3, Topics down 1.3, Bitcoin down 13.6. The pound and the euro both down a little bit against the dollar, but pretty much unchanged year to date. Likewise, dollar index pretty much unchanged year to date, and the VIX 26.8, but not very much changed from the year. So there's the FTSE World Index.
Yeah, quite a sharp drawdown, but stabilized again. And frankly, we've been here before.
Yep. Exactly. So I think there's been a bit of margin. I don't know what the margin debt position is, but I suspect there's been a bit of people being caught out with margin positions. FTSE All Share.
Yeah, really gone nowhere
Yeah.
since the start of the war.
The Euro stocks.
Same.
S&P 500. Nasdaq. Big drop on the Nasdaq, wasn't it? But still up 11% for the year.
Yeah, and frankly, just the rise since, was that April, has been absolutely extraordinary.
Yeah. And then the Russell 2000, unchanged, but up
Yes,
7%.
the Russell 2000 is saying that the US economy is doing fine.
Yeah. The Hang Seng, a little bit weaker. The Topics,
Yeah.
Bitcoin. And I've started to hear more people saying that Bitcoin is basically dead and buried than one used to hear. I
Yeah.
personally wouldn't take a punt on it either way, but I think that it's, I do wonder whether its halcyon days are now past.
If I was going to play Bitcoin, I'd buy a put.
Would you?
Yeah.
Yeah.
Because I mean, frankly, we'll talk about this in a bit, but Michael Saylor, his the strategy holds like I think 800,000 Bitcoin. This
Yeah.
latest sell-off, we'll talk about this in a bit, but was caused by him selling 25. Yeah,
25.
25. So
Yeah.
it's impossible to sell that number.
It's a psychological effect as well, isn't it?
Yeah.
Michael Saylor has been one of the greatest aficionados of Bitcoin, and
Yeah.
I saw an interview he gave. Probably I saw it about 3 months ago. It was embarrassingly bad.
Right. Yeah. Well, we'll talk about strategy in a sec.
Basically, the dollar is going nowhere, and surprisingly, even with all of this disruption in the world that we've had with Trump,
Yeah.
with the Iranian debacle, the dollar has been basically stable. This is caught. And people keep saying the dollar's going to go down. I don't understand why they say that. Uh, as the
Well, the
euro,
thing is, Richard, when you look at the deficit, and there are
yeah,
deteriorating finances,
it's going to go
fiat
down against
currency.
what, Keith? I mean, it's going to go
Yeah,
down
that's
against the
true.
pound
Yeah,
or the euro,
yeah.
the Japanese yen. What's it going to go down against?
Well, the thing is, the euro does have much lower inflation, actually.
Yeah, but it's
Yeah, Swiss franc.
Euro land is highly indebted.
Yeah, that's true.
I mean, they've all got the same problems basically. There's a dollar index. I mean, I think it will go down against hard assets, but I don't think it's going to go down against other
Yeah,
fiat currencies. That's the VIX.
yeah, which spiked up, but only to levels we would have considered extraordinarily low 5 years ago.
Yes. Uh, okay, so yes, so it was the S&P was in correction territory, and it has had a little correction.
Yeah. So basically, the 2 month change was extraordinary.
Yeah. S&P 500 earnings forecast to rise 24% in 2026, which is stonking.
Yeah, absolutely. US economy is doing just fine. And when you look at semiconductors earnings expectations, well, the share prices are tracking them very well. And the question is, how sustainable long term is this? I would say not at all. So the
Yeah,
market thinks, is reacting as though these are going to be sustained forever, and I just don't think they are.
yeah, I would agree with that. And retail investors buying options have been the driving force. So obviously, if retail investors buy options, then the person selling the option will buy the underlying stock to hedge their
Yes.
position. So it forces the underlying stock price up.
Yep.
Retail investors don't usually win on options.
No, I know. Yeah, the volatility is too high. So,
Yeah. And then the three times semiconductor ETF. I think we've seen this sort of chart before, haven't we, Keith? Up 1,500% in a year.
yeah. But the thing is, previously we've been warning don't invest in these things because unless it goes up consistently day after day,
Yeah, it
you
goes
will
down.
lose money. Any volatility is terrible for these things.
Yeah.
And so, this sell-off has been terrible. If it's now starts going, sideways or up with a bit of volatility, you're not going to make money. It needs to just go up day after day to make money.
And everyone's been piling into memory stocks.
Yeah. I mean, but look at the speed with which it's grown assets. This is absolutely astonishing. And the
Yeah.
thing about DRAM is it's old technology. You know, it's not like cutting edge EUV, you need a new ASML, super fab to make these things. You just need to, add capacity. And so we've talked about this previously, but medium term, you'd expect their add capacity margins go back to zero where they were, last few years.
Yeah. I mean, it's one of those things. If you happen to have the foresight to spot this is going to happen, it's fantastic. Otherwise, don't
Yeah.
touch it with a barge pole. Certainly
Yeah.
don't be going into it now. Google is selling 80 billion of shares to fund its AI investment. So
Yeah.
rather than buying back stock, it has issued new shares.
Yes. So I was talking to my US fund manager friend yesterday. He was saying they're selling shares because they have tapped out the bond market. If they were to sell any more debt, then the market would insist on higher yields.
And okay, US financial assets are now 6 times GDP, a new
Yeah.
record.
So I have this prejudice, Richard, which you can tell me whether it's right or wrong, that not everyone can get rich. So there comes a point where the value of financial assets compared to GDP reaches a limit because if everyone's rich, at some point, people want to convert that, all their paper wealth, into spending. Now, that is not true if you have extreme wealth inequality. So
Mm.
if like Elon Musk is worth 1 trillion. Well, you can't spend 1 trillion. Your marginal No matter how many Gucci handbags or whatever you want, you can buy an infinite number of them. So, but for the great mass of people, if everyone, and when I go down to my table tennis club, everyone's talking about how their equity investments have gone through the moon. At some stage, you start converting that into cash and spending it, which brings prices down. It puts a limit on them. So, what do you think?
Well, I agree with you. We are in seriously into some sort of bubble territory. Um, I just don't know how or when it's going to end.
Yeah. Well,
I think
you and me
that's
both. We've been here,
um,
been saying this for years now.
exactly, yeah, and it will end, but who knows how and when? And I'm
Yeah.
not touching it. But had I touched it a few years ago, I'd have done very well. But you have to do
Yeah.
what you think's right, don't you? And we've got meme stocks. Meme stocks are back. The
Yeah.
meme stock ETF is up 89% in a year to date.
Yeah. No, not even that really. Since like April.
Yeah.
Um, bull market back on. That is before the recent sell-off, that is.
And this is a sort of chart that shows the spread between top and bottom performers now versus the top, the tech bubble. Um, and so winners have outperformed the losers by an extreme amount. So are we, well, Keith and I think we are in a bubble,
Yeah.
and I think the bubble's going to pop.
Yeah.
And also, just as an aside, talking about the tech sector extreme gains and um, banks planning to lay off people because of replacing them with AI. I suspect we're going to see them re-employing those people in a few years' time as AI doesn't actually achieve what they expect it to achieve.
Um, well, last time we talked, there's that chart which I thought was extremely interesting, showing on the y-axis the capability of AI, and on the x-axis
Yeah,
the token cost
yeah,
per token. And the thing is, the y-axis was linear and the x-axis was logarithmic.
yeah.
So what I think is really concentrating minds now is that the businesses are finding that their AI costs have shot through the moon.
And they haven't finished going up yet either. They've only just started to go up
Yeah.
to match this huge amount of expenditure that's going into data centers.
And the thing is, businesses are taking steps to cap their expenditure on AI,
Yeah,
whereas the market appears to be assuming that, revenues from AI will be essentially infinite. Businesses will be substituting people for AI. But as we've talked about previously, AI appears to be a commodity. DeepSeek model is 50 times cheaper than Anthropic's.
yeah.
So businesses are going to go down the cost curve to find models that provide the best cost benefit ratio. They're not
Most
going to be paying up for, the latest model.
no, most efficient use of their resource. And we don't actually know where that is. What we do know for certain is it's not where we are now.
Yeah. Well, market expectations for revenues are that they will keep growing forever, basically. And I
Yeah.
just don't think that's true.
And Morgan Stanley here is seeing SpaceX revenue to reach 3.4 trillion per annum, presumably, in 2040.
I know it's marvelous, isn't it? I mean, the thing is, Richard and I see loads of these like hockey stick charts. Whenever you go and see any
Hmm.
startup, like they have revenues which are not very much, but they think they're going to go to the moon. And here got revenues of 18.7 billion. Yeah. And then that's forecast to like go up almost tenfold in 2 years and then hit 3.4 trillion. Yeah.
Yes, it's a stonking growth rate.
Mm. Yeah. Yeah.
It's
Um,
I mean, I was reading something about there's obviously a lot of cynics about the SpaceX IPO, and I have to
yeah.
confess I'm one of them. But I was reading something about it yesterday, and I was just thinking, so at what point does SpaceX actually fill the low orbit space above the Earth completely, and it can't launch anymore because satellites are going to be bashing into each other right, left, and center? I just think this whole thing is the whole thing is based on a Pollyanna view
Yeah.
of space exploitation.
To be fair to Musk, you know, he's got dreams to sell, and people are buying dreams at a very inflated price. This is very South Sea bubble.
But Musk is a very, very clever guy. There's absolutely no doubt about it. And I mean, a very capable guy, not just at selling SpaceX, but in the things he has achieved. Um, but the reality of SpaceX is can't conceivably be what it's being promulgated as at the moment.
Well, the thing is, Richard, when you buy anything, when you buy any financial asset, what you're hoping is that the market is underestimating its future prospects.
Yes.
Yeah. And there is upside.
Yes.
Now, when we look at the expectations baked into SpaceX, it has to go unbelievably well for you to justify the current share price.
Completely. Yeah. Yes. It's very clever technology. I like it.
Yeah.
And if anyone is a bit dubious or a bit curious about getting to Mars, they should listen to a couple of YouTube videos on the impossibility of getting to Mars with current rocket technology. Um, and it is impossible, never mind setting up a base there and getting back from it. It's
Mm,
not impossible with fusion power, fission power, even nuclear powered engines, but we don't have those at the moment.
yeah.
Okay, so OpenAI, Anthropic, and SpaceX IPO will raise more money than all dot-com IPOs combined.
Yeah.
Well,
And the thing is, there's a limit to how much they can actuly raise. I mean, when you say, because this is misleading, actually.
this is not
Because,
raising, is it?
yeah,
This is their combined market cap, not what they raised.
yes, exactly. It's a combined market cap, so this is misleading. But, the reason he's only raising 5% is that if he did try and, raise issue 100% of the capital, that would have a serious effect on basically the share price and on the market as a whole. The market would
Yeah.
have to sell a lot of stock to fund that.
So SpaceX, the largest IPO in history, and Anthropic has filed for an IPO at a valuation of 965 billion. So this is just as IPOs tend to be a worse investment than the US stock market index total.
Mm, yeah, and frankly, I wouldn't touch SpaceX with a barge pole.
Yeah. Um, and so apparently, the more IPO activity there is, the weaker the future S&P returns. So
Which
this is,
is what you'd expect, actually.
yeah, yes, it is, isn't it? Because they
Yeah.
tend to be overvalued.
Well, no, it's the pressure of selling. It's the pressure of, if you think of passive flows into the stock market.
Hmm.
So, everyone, every month, Americans' 301k plan gets pumped into the stock market. Well, where's that going to go? It either goes to bidding up existing shares, or if it's diverted to IPOs, buying IPOs, that means there's less buying pressure for the rest of the market.
And percentage of assets in cap-weighted passive versus active equity funds. So they've now crossed over. So we've fewer active funds than there are passive funds in a um, asset on an asset valuation basis. And I think we're probably all aware of the dangers of passive investing
Mm,
and how you get less and less price discovery the more passive investing you have.
yeah.
So are we going into a bear market? I don't think we are. The reason I say that is because I think that the Federal Reserve and the Treasury will step in to support share prices.
Well, you see, this is where I disagree with you. I think that at some stage we are going to go into a bear market. And I personally think we are topping out. we're now going to enter the heightened volatility where
Yeah.
valuations have got so extreme that they're going to struggle to make much further progress.
Yeah, you may be right, Keith. I'm absolutely certain that the Federal Reserve and the Treasury will do everything they can to support the market.
Well, the thing is, all you need to know is the US is running a 6% deficit ad infinitum. How
Yeah.
does that end?
Well, I agree. I mean, that's how it will end ultimately, but they will defer it for as long as possible.
Mm.
They've been quite good at doing it so far. So I think that I don't believe the Hindenburg Omen. It's like one of these things that people come up with as if it doesn't really mean anything.
Yeah. So I'll fill this in. So equities outlook. So we've been warning about a bubble in US equities for, frankly, years. And at some stage, I think a big correction is inevitable because, the expectations are unrealistic. When you look at the semiconductor stocks like the Korean index, which is all the memory chip stocks have gone absolutely through the moon on extreme earnings. The earnings have been extraordinary, but I don't think they're sustainable. So when they add more capacity, then those prices come right back down again and margins return to normal, at which point the whole bubble unwinds. That is basically my thought. So, um, and the same would be true for the heightened expectations surrounding all AI stocks. So I think we are peaking. We are now entering a period of higher volatility. Now, when you look into what happened in .com, you don't just crash on day one. What you would do is you enter this period of, 6 to 9 months where you have higher volatility before something triggers a bear market. Now, in the case, what's notable last few weeks is that Broadcom beat expectations, but its future revenue forecasts weren't as good as the market had been expecting, and that was enough to send its shares down 20% and knock the market. And
Mm.
so just expectations are really running ahead of themselves. Richard, your thoughts?
I completely agree with you, Keith. I'm minded of Jeff Curry's been doing a lot of interviews recently, and as people probably know, he was the head of commodities at Goldman Sachs for many years, knows his stuff, and he has this hard asset, low obsolescence trade, as he calls it, basically is
Yeah.
commodities, and but he also said, which I thought was quite interesting, very simple, that it's either the cycle is it's either tech or it's energy. And he is now in energy, not tech.
Right.
And that's a very simple way of looking at it. And I think the tech has peaked and energy is right at the bottom. And energy is going to, so, that's my view. You're in
Marvelous.
commodities,
I've
you're in
got loads of
commodities,
energy.
you're not in tech, you're in energy.
Yeah.
And you're also protecting your position for the chaos that is going to unfold over time with the over indebtedness of governments.
Yeah. I got loads of energy. So, suits me having
Yeah,
a good year.
we'll call you Jeff.
So I looked this up. This is the Nasdaq around the 2000 bubble. Yeah. So we have this enormous rise, and then it doesn't crash in immediately. You get this extended period of volatility, and the semiconductor stocks up 46% in a couple of months. Yeah, I just think we've had a blow off top in those, and we're now going to enter a period of heightened volatility. Mind you, the US economy is doing absolutely fine. And as everyone has said for years, which frankly, I was slow to appreciate, it's very difficult to have a recession when the US is running a deficit of 6%. But eventually, the economy adapts and requires a a fiscal deficit of 6% to just maintain its current level. So, right, now on to Bitcoin.
Ah.
So, sorry, it wasn't 25 Bitcoin. It sold 32 Bitcoin. Okay. And that spooked the market. It holds 840,000 Bitcoin. Yeah. So selling 32 spooked the market. Its average price, the price it's bought them at, is 75,700. Now, the Bitcoin price is currently, what, 62? So it is underwater. Shares are down around 70% from their peak. And Bitcoin having a
So
bad year.
it's underwater. Can you just go back to that previous chart, Keith? Just uh,
This one.
yeah. So aggregate purchase price. So so the average purchase price was 75. Current price is
Yeah.
62. So that's $10,000 of Bitcoin,
Yeah.
and he owns 800,000 Bitcoin.
Yes.
So that is that. Has my maths here? Is that 10 billion? A 10 billion loss he's got on his position.
Yeah, you're right. It's 8 billion.
So he's got eight. I'm going to round it up to 10. He's got a 10 billion loss on his position.
Yeah. But the big thing, Richard, is that he has been funding the purchase of all these with preference shares on which he's paying between an 11% and 17%, and that is in cash. Yeah.
Well, the
So
other thing, these sound like they're a pretty good investment, Keith. You get 17% on them.
yes, as long as he continues to pay. And the amazing thing is, he's made clear that the preference shares do not have a call on the underlying Bitcoin. So if he can't pay the dividends on the preference shares, the preference shareholders can't force him to sell Bitcoin to make them whole.
I feel a lawsuit coming on.
Well, anyway, punters, as Richard was saying, have been piling out of Bitcoin as it's fallen. And Saylor has reversed course after tanking the market by selling 32. He bought 1,500 at an average price of 65,000, yeah, to support the market. So essentially, he needs to keep on buying to support the market. But
So he sold 32
yeah,
to raise money and then bought 1,500.
yeah. So the only way he raises money, so he's got all this debt, he's got interest payments around 900 million a year. Okay. And because he holds Bitcoin, which doesn't yield anything, the only way he can pay the interest is by selling more shares or issuing more debt. And if Bitcoin falls and people, are worried about this Ponzi scheme continuing indefinitely, then they're not going to want to buy those shares. Or the preference shares are currently trading below par. So why buy new ones? You can buy old ones cheaper.
So Keith, just to sort of summarize this briefly, what we're saying is it's a hold. MicroStrategy is a hold. It's not a buy.
Well, I've been buying puts, frankly. So, it's Ponzi scheme. At some stage, it goes kaboom. There you go. Well, but Bitcoin is at its 200-day moving average.
Been
Is
here
it going to
before.
bounce from there?
Yeah.
I think at some stage it disappears in a puff of smoke. What's that a rug pull, isn't it? Where
Yes.
they
Yeah.
just disappear. You think it's everything's fine, and then you wake up in the morning, it's worth nothing. So yeah. Anyway, bottom line, pause, have a read. Living on borrowed time, and when it fails, it's going to take out Bitcoin. Meanwhile, actually, I was just amused by this. Do you remember the Trump coin?
Yeah.
Down 95% from its highs, but it's still got a market cap of 400 million. How does that work?
Doesn't, does it?
And on to commodities. First of all, energy, not great, frankly. So at the start of the Iran war, we were saying that, by mid-June, we're really going to be running out of inventories. We're going to be approaching the minimum. Oil prices are going to start marching higher, and they ain't. Actually, they've been drifting off. So this is the price this morning. Not great. Um, Still believe that the longer this continues, you can't draw down inventories forever, but the market has been adapting much better than anyone, I think, expected,
Yeah.
particularly me. But having stayed very long um, oil equities have done all right even as the oil price has been drifting down. Natural gas prices pretty stable over the past couple of weeks. US natural gas prices, though, falling a bit. Coal rose 11% in the past couple of weeks, up 41% on the year, as Indonesia has issued export restrictions. So, as its oil imports, presumably, it's as Indonesia is struggling with oil imports, then presumably, or gas imports, liquid natural gas, presumably it's turning to coal and restricting exports.
Yeah.
Uranium, pretty flat. This is Brent. Not the shape of chart I was expecting, frankly, although Trump has successfully talked it lower. But even without that, it wasn't going anywhere. Surprising. This is WTI. Now, according to HFI Research's WTI model, falling US inventories, and that's the yellow line, should equate to currently a WTI price of 95, and we are well below that. But they model WTI prices based on inventories, and inventories are falling. So that should mean oil prices heading up. Well, they're not, they're heading down. And when we look at inventories, we now have the number for May, but as we've talked about in previous weeks, the EIA have adjusted downwards their estimate of historic inventory numbers. So last month, the EIA was saying that global inventories in April were 2,671,000,000 barrels. They're now saying less than that. That is a fall. That's an adjustment lower, 45 million barrels. And the May number is a fall on that revised number of 67,000. So what we're saying is since the start of the year, we've used 257 million barrels from inventory, i.e. 10%. So we are drawing down. So looking at the US over the past 2 weeks, drawn down 24 million barrels. So that is what? Best part of 2 million barrels a day. Although, you know, commercial inventories have only gone down 8 million barrels because much of that's come from the SPR. US crude production has risen and is now only down 28,000 barrels a day since the start of the year. So US crude production is rising again. And the Baker Hughes rig count has ticked up, but again, really not by very much. So Anas Al-Haji is saying that what everyone is getting wrong about the oil market and why prices haven't risen is that commercial inventories have been stable. So you're drawing down official inventories, but what the market cares about is the availability of crude in the market, and it remains available. It hasn't fallen. So governments have successfully shielded the market from the disruption from the Middle East. But this is California. Distillate inventories in California are falling off a cliff. So I don't know where. That implies they'll build somewhere else in the system. And
Mm.
JP Morgan are insistent that at some point, and I agree with this, falling oil inventories must cause the oil price to rise. It, of course, has been going in the opposite direction. Now, this is a useful chart. This is European jet fuel inventories, depletion scenarios, and essentially what it shows is that it takes 5 weeks after any resolution before you would see jet fuel inventories stabilize, because the oil has to get from the Middle East and then it has to be processed. Actually, I'm surprised it's only 5 weeks. So disruption could still yet occur. The EIA is forecasting when all this is over, the market will rapidly return to surplus. But as we talked about before, how real that surplus was, we just don't know. The reality was that China was buying a lot of it, actually. It's also forecasting that US oil production will rise both in 2026 and in 2027 by 400,000 barrels a day. And notice the trend is just relentlessly upwards. And a lot of that will
But
come from natural gas liquids. It's a byproduct from natural gas production, Richard.
yeah, I was just going to say, Keith, that all the commentators who I have faith in and who, basically logical, sensible people who understand the oil market well, they say that this is not going to be resolved in 2026. And
Really?
even if the Strait opens tomorrow fully, and basically, I think what we're watching is a masterclass in price manipulation, and it's being facilitated clearly by the release of strategic inventory.
Yeah.
But it is a masterclass, in my view, masterclass price manipulation, and at some point it'll fail.
Yeah. No, I
And
agree.
it's just a question. It's not a question. I don't think it's a question of if. I think it's a question of when it fails. And you just if you believe that's the case, you just sit there and wait for it to fail.
That's what I'm doing, mate. I've
Yeah.
got loads of oil.
If it walks like a duck and quacks like a duck, it is a duck. And this thing
Yeah.
is walking and quacking like a duck,
Yeah. So,
or like an oil shortage.
well, the thing is, but as we've stated before, Iran, their optimal strategy is to wait until the oil price goes to the moon, and then Trump has to come to the negotiating table and accept whatever terms they offer. So I just think that's what's going to happen.
I think if you look at what Indonesia has done, well, Indonesia um, hasn't started to control coal exports because it's okay. It started to control coal exports because it's desperate,
Yeah,
because it can't get the oil, so it's going to have to start
yeah,
burning coal or gasifying coal and so forth. And you just look at those things and you realize that actually, in some parts of the world, there is already a serious problem.
yeah. UK natural gas prices, strangely, sort of seem decoupled from EU ones and are rising. That is not good for us. US natural gas prices going nowhere, and this is really not a good chart, actually. So, what it's showing is that we've talked about this before. The US just has basically vast amounts of gas. If the price rises, so will supply.
I think can't they have trouble getting it out, don't they? I'm not an expert on this, but they
Yeah,
can
and well, it
produce a
just
lot
needs
more than they can get out.
exactly. So the price of gas in the Permian at the wellhead is negative. Well, certainly has been
Yeah,
because there's not enough pipelines to get it out. So, it's difficult to see the price of US gas, rising significantly despite the vast amounts of LNG liquefaction that are coming on.
yeah.
This is coal having a good run. And Rystad Energy are forecasting that coal demand in the Asia Pacific region will rise by 75 million tons in the coming year. That's 2026, due to the Iran war and switching from natural gas to coal for power generation, and by 150,000 by 150 million tons in the coming years. Good for coal. If you're interested in coal, a couple of companies. So this is Peabody Coal. Notice, it was worth less than $10 5 years ago, and now, despite being well down from its peaks, it's at $27, and it still loses money, by the way. This is Yancoal in Australia, and big exporter to China, Japan, and Korea. PE ratio about 20.5. But, notice its share price has been coming down, even though the coal price has continued rising. Is that an opportunity? Question mark. Uranium going nowhere. We have a bit on SMRs coming up. Now, this is the sulfuric acid price. Now, when we talk about, fertilizer prices coming down, well, the sulfuric acid price ain't coming down, and you get uranium mainly from in situ acid leaching, where you pump down sulfuric acid into the earth, it dissolves uranium in the ore body, and then you extract the liquid, which is uranium rich. Now, so higher sulfuric acid prices mean less uranium coming out, you would think. So you'd expect the uranium price to rise, rather like the copper price has been rising? Question mark. On to industrial metals, Richard.
Thank you, Keith. So a quiet to not very good week for industrial metals. Aluminium down 4%, cobalt unchanged, copper down 0.8%, iron ore down 6%, although lithium carbonate down 5%, neodymium oxide up 0.3%, nickel down nearly 7%, tin down nearly 6%, and zinc down 1.2%. Although, apart from iron ore, they're all up on the year.
Yeah. And
a little bit of a sort of correction, I think, going on.
Yeah.
There's aluminium.
Well, there's still, still loads of aluminium trapped in the Gulf. I don't think that's coming out.
Yeah. Global aluminium inventories have fallen to less than 5 days of global supply. It's not good.
That's not good. Thank you to Ali Boyd for sending us that chart.
There's cobalt.
The FT had an article about how, the DRC have been issuing import quotas, and how cobalt stocks around the world have been falling. So, the trouble is, it's very difficult to invest in this when, if the DRC were just to issue some more, or like take the quotas off, the price could totally collapse. But as it is, it looks like the cobalt price could go to the moon.
Which would also affect electric vehicle batteries.
Yeah.
Copper, which has had a very good year, really. So it's up 13% for the year.
Yeah.
Iron ore.
Yeah, not so good.
Lithium, up 44% for the year. Neodymium. Nickel. Tin.
Now, I'm surprised that tin's coming down, actually, because tin, is massively used in semiconductors.
Yeah.
And so if demand for semis is going through the moon, then tin should also be going through the moon.
I mean, I suspect people are jumping into the commodities trade and then they're jumping out, and it's making it a bit volatile.
Yeah.
And it is a pretty volatile chart, isn't it? Looking at that one.
Yeah. Well, I remain long Alphamin.
Zinc. And precious metals, as Keith said, not a great week for precious metals. So gold down 7%, silver 12%, platinum 11%, rhodium 9%, and palladium 6.5%, and they're all down year to date. So there's gold.
Okay, Richard. Now, I wanted to ask you about this because you are, very bullish on gold. I have to say, I bailed out on all my gold positions earlier this week because I just didn't understand it. I thought, this is not doing what I expected it to, and I'm going to sit out and wait because I couldn't see a catalyst for this. What's going on?
So I think that there's a few. First of all, it's a long-term trade,
Yeah,
um, and secondly, in gold bull markets, actually in most commodity bull markets, you do get big drawdowns.
yeah,
40, 50% drawdown. It's not unusual. Um, so this particular drawdown doesn't mark, to my mind, doesn't mark the end of this bull market
right.
at all. Then obviously the interest rates in the US have gone up, so that makes the US bonds relatively attractive. So
Mhm.
big money will move from gold, which doesn't have a yield, into US bonds. Um, but and then there's the SpaceX IPO, all the other IPOs, which maybe a lot of trading has been on margin. People get caught out
Mhm.
with their margin trading. But all of the long-term drivers, including central bank buying, are still in place.
Yeah, I agree with that.
So none of that's changed at all. In fact, you could argue that they've got stronger. So we've got
Yeah.
higher inflation, more global uncertainty. The US debt position is getting worse, not better, because the interest rates are going up. By the way, gold does go up when interest rates go up. It's just there's been
Mm.
a meme over the last few years that it doesn't, because it's suited various people to promulgate that message. So yeah, I think it's just a long-term trade, and it's bouncing around, and it's having a consolidation.
Well, because the other reason that I decided to liquidate my gold and actually also my uh, metal royalty companies, or actually, frankly, at a whopping loss, was that A, I didn't understand what was going on, but B, I really were. So we've talked previously, we were talking about equities, about how we are in a bubble. And now, when that bubble bursts, and I think it will burst, that people liquidate their gold to fund their margin calls, essentially. And I think that is coming up at some stage in the next couple of years, and there will be a great buying opportunity in gold.
Yeah, I mean, you may be right, Keith. My view is I don't try to time the market, because I can't.
Yeah.
I know that if I try and do that, I fail. So I don't try and do it. So I have my long-term thesis. I believe it's still intact, so I stick with it. So I
Yeah.
haven't sold anything. Um,
Very good.
He's sitting on my hands, just waiting for the next move upwards, and hoping that I'm right. I can't see that I'm wrong. It doesn't make sense to me that I'm not right. So,
Yeah.
but
Well,
these things, and I can't control what the rest of the world does in the
yeah.
short term.
No, medium term, I'm very, very worried about the fiscal situation in the US and how that ends. Because it either ends in a depression or it ends in monetary debasement. And there's no societal tolerance for depression. Therefore,
So the end point has to be a tying of fiat currencies to gold. I can't see any alternative. And it doesn't mean to say that it's a gold standard. It just means that there
yeah,
is some connection reinstated. It's not tying fiat currencies to Bitcoin. Um, so, um, the end point is still the end point. And in
yeah,
fact, the end point has been exacerbated by Iran, etc. Um,
yeah,
and it's a bit like the oil price. You think the gold should have gone up, but it hasn't. And the oil price isn't doing what it's doing. But you just have to wait and bide your time.
yeah. Well,
What I'm doing.
um, medium term, I agree with you. And my daughter remains like 100% in gold in a sip, and she's done absolutely fine. Thank you very much. Um, but I think there will be an opportunity to get into gold when this bubble in DRAM stocks, etc., bursts, and I think it will. I think gold goes. There's an opportunity there for gold, but I would be waiting for that to happen.
You may well be right, Keith. So I don't dispute that at all.
I haven't been right on pretty much anything in the last few years, so you've done well.
So then we have central bank gold purchases, which are continuing pace. I mean, there's been a lot of talk about Turkey selling its gold, but I think it's going to start buying it back fairly soon.
Yeah.
Um,
What about us? We, the brown bottom, and we sold all that gold for like
well,
peanuts.
Keith, I have absolute faith in our central bank, the Bank of England, and our Treasury, and I'm sure that sub judice they are buying gold hand over fist to protect our position, just as they are ensuring that we are safe by properly funding defence and not wasting money, taxpayers' money, on garbage like net zero.
Yeah. Mm. Moving on.
Just my view.
Yeah.
Silver
Yeah. Not great.
consolidating, as I like to think.
Yeah.
So this is solar. I mean, there is a counter argument with solar that copper is starting to become viable as a substitute for silver in solar panels,
Is it?
beginning to. Yeah,
Wow.
just beginning to. But of course, yeah. So it hasn't obviated silver entirely, but it means that you need less silver. But the technology is new and it hasn't really got into manufacturing yet, I don't think.
Okay. Because, when you look at forecasts for electricity generation, there's vast amounts of solar.
Yeah,
And
I mean,
that, yeah,
so electric vehicles use a lot more silver. So there are swings and roundabouts, I think, as well. So and we don't
yeah.
have transport in there, do we?
And reminder, the silver market is in deficit, has been in deficit for years.
And most silver is produced as a byproduct of other metal mining, metal production.
Yeah.
So there's platinum.
So right back down to where it was at the start of the year,
Yeah.
actually below the start of the year.
Yes. Rhodium, likewise, and palladium.
UK rates, the yield curve is down from its highs as the UK political crisis takes a pause. We await the Makerfield by-election, but frankly, given what I've read about Andy Burnham's intentions for UK fiscal, so the latest appears to be that he's promised the waspy women that he's going to give them over 10
Oh
billion,
no, he's rode back on that one, Keith.
has he?
There's
Yeah.
nothing if not inconsistent.
Well, I see absolutely no justification for giving, these women any money, given that they live far longer than men and etc. Anyway, but that crisis will recur, I expect, when we have the leadership contest. More political uncertainty coming to the UK. US yield curve also appears to have stabilized, but at much higher levels than last year or pre-war. This is the UK 2 year, seems to have stabilized, but not great, well up from pre-war. Inflation everywhere is having an inflationary impulse. ECB's raised rates, expect the UK Bank of England to do the same. 10 year not getting worse, down from its political crisis highs, 30 year the same. 5.6%, that is the risk-free rate in the UK. If you're borrowing long term and you have to put a risk premium on this, you're borrowing at what? 9 or 10%? US 10 year, 4.5%. German, stable actually. France, Italy, Japan, look at that. Actually down quite substantially in the past couple of weeks. Trend remains up. Okay, now, Richard, your thoughts. Current investment themes. Right, to me, that is the bull market in equities finally peaking, question mark, is a theme now. Now, Richard thinks not. I think valuations have got so extreme that at some stage we have to have a bear market and to unwind some of this fluff. Disruption from the war in Iran. Well, the market appears increasingly confident that this can be managed. And I just think that they are way too complacent. I mean, when you look at sulfur prices are what I expected oil prices to do, and they ain't. And,
Yeah.
so Doomberg was posting these pictures of these enormous stockpiles of sulfur in Canada. And, but you've seen the sulfur price going through the roof.
What was the purpose of his posting, Keith? What was he
He,
saying?
he was saying that, how can the sulfur price, rise when we've got just vast stocks of it? Well, it is rising.
I don't understand Doomberg. I don't understand him. I don't understand why, as a general comment, I probably said before people pay any credence at all to an anonymous green chicken. And the second point is that he's always he feels to me a bit like a shill for the establishment.
Right. Well, I mean, his point is that commodities have been in abundance, but I think our point is that they've been abundant, but you can't have exponentially rising consumption of a finite resource forever.
And also, you have to be able to extract it.
Yeah,
And just because there's a lot of it in the Earth's crust doesn't mean to say you can get at it.
yeah. No, that's right. I need to, when I get back from my holiday, I need to start work on the copper part two. Anyway, so monetary debasement seems to be off for a bit because, gold and silver are coming down in a way that I don't understand, given that,
Oh,
you,
it's just a consolidation in the process, Keith, in my view. I don't think the red line should be there. I think we should
right,
be that's intact.
okay, right. Geopolitical uncertainty,
Well,
again,
none of that, is it?
sorry.
None
Well,
of that, is it?
yeah, I know, but, the gold trade is off. So, yeah,
Yes.
fads are still very much there. Now, this week, and I'm going to consult on this, we're going to do the economic data, all the bean counting about the UK, EU, and US economies at the end. And we're going to talk about the more interesting stuff first. So, first of all, one chart. On this chart, on the y-axis, you have the average price of Brent crude in dollars per barrel, and on the x-axis you've got OECD commercial crude oil inventories. Yeah, note commercial. So all you need to know is if crude oil inventories keep falling, and so far, obviously, the official sector has been releasing oil so that oil inventories actually have been stable. But when the SPR releases stop, or when China runs out of its black inventories, then commercial oil inventories fall, oil to the moon. And right, gold has fallen in a way I absolutely didn't expect. So I asked SimonW to do technical analysis, renew his technical analysis. Where does he think we are? So this is gold. And gold has broken through the short-term support at 63.50 and is now looking oversold. Well, he was right because since he did this 2 days ago, Trump has, said nice things about the Iran war, and it's had a bit of a bounce this morning. And so he was saying that the support line here at 3950 and it's bounced off that. If it breaks through that, then the next support line would be much lower, about 3,500. And it's saying further weakness likely. And I notice that this morning, having bounced yesterday, gold fading again this morning. Now, Jesse Colombo had, I thought this was quite a good chart showing the support zones. So we're in this support zone here, and if gold falls through that, then the next support zone is in agreement with Simon. down to 3,500. This is silver, and he's saying that there's this kind of oscillating pattern, and we're now oscillating down. Next support line is around 55. Richard, any thoughts?
Maybe. I
No.
mean,
Okay.
and
So,
you know, it may do, it may not. I don't know. And I have my long-term thesis, and I don't
yeah,
really, what's going to happen over the next few weeks is not relevant, unless something happens that is relevant, but nothing's happened that's relevant other than
right.
to
Okay.
confirm my thesis. So yeah, it's the point here is if you want to trade,
Yeah,
then that's fine, but I don't want to trade. I don't trade. I've made a conscious decision that trading in and out of things doesn't really work for me. So
yeah.
therefore,
Yeah, I'm not
um,
sure it works for me either, but yeah, I do it.
yeah, I mean it's hard not to because one is subject to the normal human emotions, but
Yeah,
um, it's best, in my view, it's best not to. I mean, for me, other people must do
yeah.
what works for them. But for me, it's best not to.
Well, I mean, my old
And it's
trade,
done very well. For, if
yeah,
you look at, I've held gold since it was 1,200.
wow,
Um, it's done very well for me, and I don't really mind if it oscillates a
yeah,
bit. I know where it's going.
yeah. Well, I mean, holding on to my oil positions has been absolutely the right decision.
Yeah.
So this is copper. So holding close to its all-time highs. Upward trend remains intact. S&P 500. Now, it topped out at 7,620. The resistance line is at 7,000. This says it bounced off that. And the year-end target at 7,700 remains in place. Now, you note that 7,700 is not much higher than 7,620. And that implies, we're going into a period of volatility, I'd say, rather like I was expecting. The Nasdaq Composite peaked at 26970 and is saying expecting a 10% correction, near-term support at 24,000. But again, broken through the top end of the range, has come back down to within that range, is still a long way from the lower end of the range. So the bull market remains intact. Now, we talked last week about Credo technology, which and how it had there was a golden cross and you should get in, and I bought some, and it is up. So there you go. And I've actually
Congratulations,
increased
Keith.
my positions because hell, Simon seems to know what he's doing, and so it's a punt. So Simon is playing this through options actually, and he's saying that if it breaches 255, it'll go on to 300. So I've asked Simon actually to uh, do a regular or intermittent feature on companies where he thinks that it's got a golden cross and it's going to go up.
We could have the SimonW portfolio.
Yeah. Well, I don't think he wants to share that much, but we could have, he's like,
Well, no,
uh,
not his portfolio, but
yeah,
yeah.
yeah, exactly. But, not recommendations, but interesting, good setups, stocks with positive setup, technical
So here's the
setup.
question then. I would consider a trade in oil, not oil companies. And the question is, when is the right time to buy oil on the basis that it is going to go up somewhere between 150 and 200 over the next 6 months?
Mm, don't know. But, it's drifting down currently, mate. So,
Yes.
it'd be quite a good, if you think it's going to go up to 150, it seemed like quite a good time to buy it.
Yes. What do
Everyone,
you think?
um, I think that the Iranians are actually playing this quite well currently, in that I I think they will just string Trump along with peace negotiations while waiting for the oil price to go to the moon. And so,
Yeah.
you know, apparently they've given him a set of proposals, and Trump has, agreed most of them. And because these proposals came from the Iranians, Trump is now saying, well, we're almost there. But I just think the Iranians will stick to the letter of they won't give any ground on nuclear. And if Trump agrees, they'll probably switch and say, well, actually, we want this now because they've got the whip hand.
Yeah, you could well be right, Keith. And also, surely reparations aren't acceptable to Trump.
Well, as long as he's not flying US dollars to Iran as Obama did, I think they might be. But
Right.
the bottom line is Trump will describe anything as a victory, you know. So this question of the only thing I think that really brings him to the table is higher oil prices. And
Yeah.
the thing is, Iranians absolutely are under pressure. The inflation's very high, but I'm sure they're exporting loads of oil via the trains to China. There'll
Hmm.
be workarounds going through, overland through Pakistan, etc., etc. They are also adapting.
Yeah. Yeah, I'm sure you're right, Keith. Hmm.
The usual disclaimers apply on the technical stuff. Thank you to Simon W. Obviously, if you'd followed him rather than me over the last few years, you've done much better. Right now, let's talk about oil. OPEC monthly report. Okay, so this is from the IEA, who are funded by OPEC, but obviously have actually been much more bearish about oil, the outlook for oil, than OPEC probably would have liked them to be over the last few years. They were big on the energy transition. Now, according to the OPEC monthly report, OPEC output has fallen 9.7 million barrels a day. That is enormous. That's absolutely huge. Huge disruption to 10% of global oil supply is off market. Okay, and they're saying that it fell. These are numbers for April. So war started in February. We got a drop in March, further drop in April, and a substantial drop of 1.7 million barrels a day. So going through member by member, this is Algeria, and they've stabilized, but no positive supply response. Republic of Congo, nothing, tiny. Equatorial Guinea. I mean, really, this shows you how OPEC has been hollowed out. You know,
Hmm.
Gabon, um, Iran. Now they're saying this is really interesting. They're saying actually Iranian production has not been affected very much.
Well, this is to the end of April, Keith.
It is.
And they were producing to store, probably.
Well, I think you can't store a month's worth of a million barrels a day. They don't have that much storage. I think they're sneaking it out or putting it sending it overland. Iraq, on the other hand, kaboom! Iraq has problems. It can't
Because they can't get it out,
they
presumably.
can't get it out. They're just shutting it in. Kuwait, again, can't get it out. Libya, stabilized. Nigeria actually stabilized. Did look like it was collapsing, but it's stabilized. Saudi, again, trapped. They're getting oil out via the East-West pipeline, but it's fallen a lot. UAE, similar, down 1.4 million barrels a day. But when you look at all that, it's Iraq that is the big loser. This is Venezuela, and actually not much of an increase.
Well, we always said it was going to take several years for Venezuelan oil production to increase and that they haven't got the kit and it needs to be massive investment and so forth. So
Yeah,
Trump's optimistic words have proven to be just that.
yeah. Now, on your point, Richard, refinery throughput is down 3.5 million barrels a day. That's 4%. Most of that drop originates from the Middle East, China, and elsewhere in Asia. So, elsewhere in Asia, they just can't get the crude. basically. So you're reducing refinery runs. Middle East, obviously, if it's Qatar, then you can't get the refined products out. China has seen a big drop, and presumably that is because it's A, can't get the crude and is just running off inventories.
Hmm.
So the IEA estimate a demand is down 2.5 million barrels a day. Previous chart was saying five, but they're saying refineries cut back and higher prices curtail consumption. I think 2.5 million barrels, that's a high estimate. I can't see that. And again, I think Richard's point about, reduced refinery runs being equated with reduced demand is apposite. The IEA are forecasting that demand will rise by 1.5 million barrels a day next year. And when you look at that China chart, you see nothing to indicate that demand is peaking anywhere. Meanwhile, the IEA are forecasting US shale output has peaked. The EIA are forecasting the opposite. More on that in a bit. Now, peak oil barrel, where I get all these charts from, estimates that if the straits remain closed, around 8 million barrels a day are off market. Yeah. And so if we calculate how many days of commercial stocks are available, then, we can last for a while. But when do oil prices start to seriously rise?
The problem with all this, Keith, is that I mean, it's obvious. I think it's obvious to me anyway that the oil price has been manipulated to keep it down, which obviously is
Yeah.
stopping demand destruction. But actually, the more demand destruction we have, the longer the tail this tail becomes, and the sooner you start demand destruction, the longer the tail becomes. And so the actual policy is the antithesis of sound, sensible management of oil
Mm,
stocks. And it's, what's actually happening is yet more lunacy in rather than saying we've got a problem, we need to curtail demand, we've got a problem, we need to pretend it doesn't exist.
mm. Well, you can't keep on drawing down inventories forever, and at some stage you're going to have to rebuild them.
Precisely. So, the price of oil needs to go up for demand destruction to properly take hold.
Yeah.
And that is the only solution. This is what's actually happening is utter madness. But yeah, we have, in my view,
Well, apparently we've lost 1 billion barrels, drawn 1 billion barrels out of inventories. So, you're going to have to buy oil from the market to refill them in future. And I'm sure lots of Southeast Asian countries will now be thinking, actually, our inventory is not big enough. We need to build some storage and have a bigger buffer.
yeah, they'll also be thinking we can't rely on Middle Eastern oil, we can't rely on the US.
Yeah.
We need to sort out our own energy, and so that will drive them to coal, which is very bad for the environment, as we know. They will drive them to coal. Um,
Yeah.
and there'll be a wholesale realignment of the energy market, and presumably there'll be many more nuclear reactors in the pipeline in due course as well.
Mm. Yeah. More on that later. Okay, let's talk about US shale. So the IEA is saying the US shale has peaked. The EIA are forecasting that actually it's going to keep rising in the next couple of years. So rise by 150,000 barrels a day in 2026, and then by 600,000 barrels a day in 2027. So that is a significant rise, although nowhere near as much as we've had historically. Now, regular viewers of the podcast will know that Goering and Rosenzweig think the opposite, and they use this chart showing year on year growth in the Permian. It has been steadily falling as you basically have mainly started to drill out the core areas and you're moving into
Yeah.
the secondary areas. So you're now getting declining productivity per lateral foot. And also you are approaching the halfway point in terms of drilling all the well locations. So at that point, when you're halfway through, presumably you then start to decline.
Yeah.
But reminder, the shale revolution is a technological revolution. And the thing about shale is that the recovery rates are extraordinarily low. So they're typically in the range of 5 to 10% of the oil in place. Yeah. So your shale well gets out 10% of the oil there, leaving 90% behind. If you can do anything to increase the recovery rate, then you could massively increase the amount of oil you are getting from your shale wells. And the Department of Energy is on this. This is like, despite not being funded very well, the US government is, very good at funding research into shale, which it then shares with the whole industry. And so it's 17 different experimental sites. Pause and have a read if you're interested. CO2 enhanced oil recovery in the Bakken.
Midwest.
Yeah, so can enhanced oil recovery lead to higher recovery rates? Now, so the two areas they appear to be currently concentrating on are gas flood. So what you do then is you pump gas down into the reservoir to force the oil to flow in front of your whichever gas you're using, CO2, nitrogen, or natural gas actually. Or you do a chemical flood whereby you pump down a load of surfactants into the reservoir to release the oil from sticking to the rock, to improve its mobility so it'll flow better to your wellhead. Now, this works. Now, look at the oil recovery factor. So it's called huff and puff. Basically, what you do is you pump in the gas in bursts rather than in one continual flow. You up the pressure, you let the gas move through the rock, then you do it again. And so you get substantial increases in oil recovery. But this technique is not new. Been experimenting with this since the 2010s. And
Is it currently being used, Keith?
not much, no. We'll get on to that in a second. So there are lots of these pilot programs, mainly using natural gas, because you need vast amounts of gas to do this. Yeah. And you've got loads of natural gas around. It's what is near at hand. And in the Permian, it's currently selling a negative prices at the wellhead, or sorry, it was. So it killed two birds with one stone. So why hasn't the shale industry gone big on EOR, on Richard's point? Well, it's a question of economics. In order for enhanced oil recovery to be worthwhile, it has to have a higher return on investment than simply drilling a new well. And so currently it doesn't, basically. So what they are doing is things like the chemical floods, because that's a marginal increase. So when you're drilling your new well, you can put some surfactants down. You don't have to basically do a complete new operation like doing a gas flood. Yeah. So it's a marginal increase that's very easy to do. But we've talked about that before, and how much of, the chemical flood is already in the production numbers. When we talk about this gas flood, a normal shell compressor works at 4,000. That's 4,000 psi. That's 270 atmospheres. Reminder, you're fracking the rock. You're breaking the rock apart. So you need enormous pressure. A gas injection EOR pump requires 9,000 psi, 600 atmospheres. So you need specialist equipment, this all sounds incredibly expensive, frankly, and it requires up to 15 million square feet of gas a day. Where are you going to get the CO2 from? Question mark. And at what cost? So bottom line is, I'm not convinced that EOR is going to lead to a massive increase in shale productivity recovery rates in the near term. It's a question, everything comes down to a question of cost. You know, are you going to re-enter wells, do a whole gas flood with pumps that do 9,000 psi when you can just drill a new well? I don't think so. We've talked previously about new technologies they are using, like pet coke as a propellant and surfactants. So skeptical, frankly. I think they'll just, when it comes to the outlook for shale, it's all a question of price. If oil prices are high, then it doesn't matter that you're halfway through. You can just drill a load of new wells and produce more oil. Bottom line, there are plenty of hydrocarbons in the world. If the price is right, we'll find a way of getting them.
Yeah.
But we've taken you through that. The technology you require to get these more difficult hydrocarbons out, is extraordinary and is expensive.
Also, the price needs to be high and stable so that companies feel confident in making the investment.
Yeah, that's a very good point, Richard. On to small modular reactors, Richard.
Thank you, Keith. So, the Institute for Energy Economics and Financial Analysis states that small modular reactors are too expensive, too slow, and too risky in summary. So these are cost estimates for keep on rising. So you can see that, for example, NuScale, the cost estimate was $10,000 per kilowatt.
Yeah.
In 2015, up to and now it's increased to 23,000. Well, in 2023, X Energy was 4 to 15, and Hitachi's well 2 or 3 to maybe 10. So also, I mean, I think there is only one. I think there's only one functional small modular reactor producer, which is BWX. We can go on to that. So I'm sorry, I'm preempting. So there are 4 SMRs in operation in the world. One in China, 2 in Russia, and 1 in Argentina. And actually, there's many also operating in various nuclear submarines and nuclear powered warships.
Yeah. Price insensitive, though.
Absolutely price insensitive, and also protected by all sorts of secrecy agreements. So the projected costs of the Argentinian one have climbed 600% since work began in 2013. Forecast to enter service in 2027. I mean, this is a huge, huge increase, isn't it? Particularly when it's only a 25 watt reactor.
So, all of them have seen massive cost increases.
Yeah. All the US SMR startups have suffered from very significant cost overruns. So you can just see the trend is sort of roughly a doubling over the period of time from inception to 2023.
Yeah. So, I mean, X Energy is extraordinary. So they thought they were going to be cheaper than everyone else.
Yeah. They have suffered from large construction time overruns as well. So they take a lot longer to build. I mean, the concept here is that you put it in a container, or you build it in a factory, you put it in a container, you ship it out, plug it in, and then when it needs refueling, you swap it over for a new container, isn't it? That's the actual concept of these things, the sort of ideal concept of these things, as opposed to building them in situ permanently. And construction overruns, time overruns are a feature of nuclear reactors as opposed to a fault.
Yeah.
It's not a bug, it's a
Absolutely.
feature.
They're just extraordinary numbers. Flamanville, and you'd think the French are good at this,
Yeah.
because they have loads of nuclear power points. plants. There's said 5 years, 16 years. Hinkley Point C, 7 years, 16 years. You know, nuclear
Yeah,
reactors,
they are very, very difficult things to build, aren't they?
precisely, you've got to get it right. And, new designs just take a long time.
So the Department of Energy's got this pilot program which has made getting um, approval much more quickly. The approval is available within 12 months if they build their reactor on Department of Energy land. Otherwise, they're really trying to speed this process up with approvals, which is fine as long as they're safe, and that's the
Yeah.
question, isn't it? And then there are three companies racing to get their SMR projects into production by July 2026, by the 4th of July. It's
Yeah.
Valar Atomics, Antares, and Allo Atomics. But I do think when they say into production, I think they mean producing first power, which is not the same
Yes.
as
That's
actually.
true. That is very true. But that's less than a month away.
So Valar is producing one based on high temperature gas reactor technology, um, uranium encased in carbon and ceramics. And the helium is used to cool the reactor, transfer heat to the steam turbine. But I believe helium has problems, doesn't it, in that it causes the casing to become brittle, a bit like hydrogen has the
Yeah.
same effect.
Yeah, but I looked into this. This is a well-used technology.
Yeah,
So they must use very specialized steels to
yeah.
to stop the helium embrittlement.
Probably contains a lot of Chinese sourced rare earths.
Yeah.
So the Antares R1 uses the same uranium pellets, but has a passive sodium heat for primary transport. Presumably that's liquid sodium, isn't it?
Yeah.
Closed loop nitrogen Brayton cycle for power conversion. What is a closed loop nitrogen Brayton cycle?
Very good question. Okay. So essentially, you are using nitrogen in a closed loop here it drives
Oh,
the turbine.
yeah,
You heat it up in the reactor. It
yeah.
expands, drives the turbine, and then you're cooling it, recompressing and sending it back. I was amazed that
So there's no secondary cooling. I mean, there's no steam-driven generator turbine. It's
yes,
just initial. Okay, very clever. And
yeah.
presumably,
The point is, Richard, that you can do this. You don't need a water source. So
yeah,
when you talk about sticking it on a container, you can put it in a desert where there's no water, and you
yeah.
can still get power out.
And presumably it's pretty efficient because you haven't got a second heat exchange process going on.
Yeah, but 20 times atmospheric. They were saying relatively low pressure, 20 times atmosphere.
And it's not as much as fracking, Keith.
No, that's true. But then fracking breaks rocks apart, mate. You know.
So reactors with a power rating of 100 kilowatts, which isn't really very useful, probably to 1 megawatt. I don't know how you pronounce that word. Atomics is developing a 50 megawatt sodium cooled SMR that will drive a steam turbine.
Yeah. Okay.
Other companies are Radiant, Natura, Okla, Last Energy, and Deep Fission, but they're all quite a long way off, I think, aren't they?
Yeah, but the point is there are loads of them,
Yeah.
and they've all got big plans.
And then the Rolls-Royce is a pressurized water reactor as used in our nuclear submarines. And planning to build 16 SMRs in the UK with a nameplate generation capacity of 470 megawatts, quite chunky actually,
Yeah.
based on the Royal Navy submarine reactors.
Do you remember? Do you remember this? Or that ages me, but do you remember Doctor Who when it was in black and white? And I was like, one of my childhood memories is being petrified by the episode in which there are these giant maggots going across the British countryside. Well, it turns out to have been incredibly prescient. There you are. Rolls-Royce is building them.
Hopefully they're not going to be moving.
Yeah.
I remember being terrified by the Cybermen.
Yeah.
I remember, this is an aside, Keith, but my father had a godson who was an actor, and acting is notoriously difficult to get into. But
Yeah.
he was very pleased he got a part as a Cyberman. Of course, you never get identified, do you? This is
Well,
this thing on there.
perhaps he just told his dad, I'm there on Doctor Who. I'm the one on the
Yeah.
left.
Yeah, I was one of those as well, actually. So Rolls-Royce is saying that the SMRs will have a levelized cost of energy of 30 to 50 pounds per megawatt hour over a 6-year lifespan, which is a lot cheaper than a 9,525 for Hinkley Point C.
Yeah. We refer back to the charts at the start of this little segment, which, you start low to get approval. And then when you start building a nuclear reactor, well, you're not going to abandon it halfway through, are you? So you just
No.
go back and you say, oh, sorry, it's going to cost a lot more. You need to give me more cash. So, frankly, I don't know where this is going to end up, but it's going to be higher than that.
What is the bottom line? Well, a lot of people are trying to build SMRs. I'm sure some of them will be successful and some of them will be installed. It is a competitive in comparison to wind and a lot cheaper than offshore wind. So apparently, so
Well, the thing
time
is,
will
Richard,
tell, won't it?
you'd say that, the whole point of this is that you get to a point where you're producing them on, uh, like there being manufacturing line, production line. And so the initial ones could be very expensive. But when you've got your production line in operation, then the cost comes right down. As opposed to, Hinkley C, where it's like vastly expensive and you're only building
Mm.
one of them. Here, first ones may be expensive, but then down the line, you're just rolling them off the production line. And if this works, and actually I think it will, then you could see a lot of small nuclear reactors being churned out. And that has to be good for the uranium price.
Yeah, I would agree with that. So we are running our stockpiles down quite substantially now, aren't we? In fact, I don't think there's a huge amount left because the lot was released, wasn't there, with the weapons to power program of the
Mm,
decommissioning of nuclear weapons. And obviously, also demand was significantly reduced in Japan after the tsunami.
mm,
Um, but this is so showing that new nuclear demand is likely to move the market deep into the production deficit.
yeah. Now, the proviso for that is, of course, that nuclear reactors don't use uranium. They use refined uranium. And so actually the bottleneck may be in the refining, not in the you know, raw commodity.
Yes, that's very true. Supply and demand, I mean, it's projected that there will be a significant increase in supply over the coming years as new mines come on, existing mines ramp up production.
Yeah, but demand will grow even faster.
Yeah. Hmm. So, where are the opportunities? Existing producers such as Cameco, Paladin Energy Fuels, the developers.
So,
Um,
Richard, rather than go through all these, do you own any of these?
uh, I do. I own Sky Harbor Junior
Right.
Explorer,
Okay.
and I also own something called BWX Technologies, who do make the US
Right.
reactors for the Navy, but they also make reactor components.
Ah,
So they're the picks and shovels as opposed to well as actually. And I own the Sprott Junior Uranium Miners ETF.
yes, I should have put that on. Yeah. So I own Uranium Royalty Corp, and that is a genuine long-term holding. I'm just
Yeah,
not selling that.
yeah. But
So,
I don't own the biggies.
yeah. So this is some charts. All this is earlier in the week. Cameco. So one of the world's largest producers of uranium. It's done all right, actually. Paladin Energy, um, not so good, frankly. Energy Fuels, it's the only conventional uranium mill currently operating in the US.
So if you listen to Rick Rule, he thinks that the uranium shares actually have a long way to run, but that it's going to be quite volatile.
Yeah. Next Energy, Denison, this is a Canadian company. Um, this is not looking good. Developing a uranium mine in Niger.
Oh, I actually own this.
Do you? Right.
Yeah, but I
Okay.
didn't buy it until early 2026.
Uh, so how are the jihadis doing in Niger?
I mean, it is a bit high risk.
Yeah. This doesn't look good. Boss Energy in uranium, in Boss Energy in Australia. So shares have fallen sharply after the company said the resource was smaller than originally thought. Anyways,
We
pause.
smaller than originally thought, but we managed to raise some fundraising. Thank you very much.
Yeah. So this is the one I own, Uranium Royalty Corp, and is acquiring streams on royalties and uranium mines. So this is a long-term hold for me. So quickly, what does Goldman Sachs think of the economics of the AI build out? So essentially, what they're saying is that it relies on four big assumptions. You know, how long these semis will last for, how long they'll be economically useful for, the cost and the complexity of the data centers, the chip architecture choices, so whether you choose GPUs or um, custom ASICs, so application specific integrated circuits, and then also on power, labor, and equipment bottlenecks, which, if you have those, then they can feed back and undermine our confidence in the whole thing. So Goldman Sachs are forecasting absolutely amazing 7.6 trillion of AI capex for the coming years. Yeah. So this is why AI stocks, semiconductor stocks are going through the moon. Everyone is expecting not just they're all making huge amounts of money on current levels of capex, and markets like Goldman Sachs are expecting, well, actually, that's going to carry on for a good few years yet. They're going to keep on growing capex. So, what are the assumptions on which those forecasts are made? So, starting off with the economic life of these chips. So, it's commonly assumed to have 4 to 6 years life because they physically degrade, but more importantly, they become obsolete. Um, and we know that the chip cycle has accelerated. Data center buildings are forecast to have a much longer cycle, 20 to 25 years. But the point is, there's a huge amount of uncertainty in this because you know that the semiconductor companies like Nvidia are constantly upgrading, producing new chips which are better than the old versions. In 4 to 6 years' time, are you really going to be using chips that are 6 generations old? So when you look at the cost of building a data center, it's mainly compute. If you look at this table, you will see that the useful life of the silicon has a massive impact on the depreciation charge, i.e., how profitable it's going to be to build these data centers. 3 years, you are massively increasing the the relative cost of your data center. Data centers are becoming larger and more energy intensive. So, we're currently on Blackwell, we're going to get to Rubin, like 1 gigawatt of power, and you need liquid of cooling. The power per rack just keeps on growing. So traditional cloud data center construction costs around 10 million per megawatt, but that's been rising. The next generation, because you need more advanced cooling, etc., 15 to 20 million. So, I mean, the bottom line of all this is that the estimates of the size of the AI capex investment are highly sensitive to a few key variables, changes in which can radically alter the economics of the data centers. And the market is making big assumptions in a period of very high uncertainty, particularly about how useful, what the useful life of these chips is going to be. Technology is rapidly evolving. It may yet completely change demand requirements if new AI models are developed, for example.
If you do a little sum in your head, I like doing little sums in my head. This is, and shoot this down if it doesn't make sense. But let's say that the capex is 7 trillion, which means you've got depreciate. Really, probably means you've got to have revenue of 2 trillion a year to cover the depreciation
Yeah,
and running costs. Let's just say that's it. So revenue of 2 trillion a year in terms of US is what, 7% of 6 or 7% of US
yeah,
GDP.
GDP.
Is that does that make sense?
It only makes sense, Richard, if you have a massive increase in GDP.
Yeah.
And my wife has been using ChatGPT quite a lot recently and has been moaning about how useless it is.
You
Um,
heard it first, guys.
yeah, it's just that everyone who's, on the one hand, I read a report how AI had solved a very difficult maths problem that was taking a team of researchers years, and it had done it in the course of 5 days. But when it actually comes to its practical use, a lot, most people I know are complaining about how unreliable it is. So I'm just not sure. And you're not sure does not equal, huge bullish and 7.6 trillion of capex.
I also think the chart that we had earlier or previous week, where, as you mentioned, referred to today, where you've got cost the cost of sophistication effectively,
Yeah.
and that every model has costs exponentially more to train. But a lot of what they're now beginning to train on is AI produced information. And at some point, it sort of becomes totally recursive and disappears up its
Yeah.
own backside.
Yeah.
Um, so you get a degradation of the quality of the training.
Yeah.
And I wonder whether that is also actually basically a limiting step to these models that effectively you can't train them beyond a certain point because what they're being trained on is wrong. Too much of it is wrong.
Mm. Yeah. Well, so far I've been dead wrong. The AI stock's gone through the moon, but the assumption, everyone just seems wildly optimistic, as they always
Well,
are in new
unfortunately,
technology.
Keith, you're now in the market, so you're hedging your bets.
Well, I have some Credo technology. I've got oil and Credo technology. So, we'll see. I,
Keith's diversified
yeah,
portfolio.
exactly. I hope the bubble will last for a few months yet. I think it's going to be volatile. I think on my view, and I've been wrong on pretty much everything, as you all know, is that we're now entering expectations have got way beyond themselves. And the numbers are so big, 7.6 trillion that this is what's in the market.
Yeah.
So, yeah, in order to sustain this, the numbers will have to get even bigger, and I just don't see it. So I think we're entering a topping period. And, just like the thing about gold, the movements in gold, is I was astonished how fast they were. It's that, suddenly, beginning of last week, it was dropping, silver dropped 10% very quickly. And the thing is, you have to start trimming positions in advance of that. Use the volatility to increase your cash positions because at some stage, you know, if, for example, the equity market sell off and gold sells off, that is a great time to buy gold. Cash is
Yeah.
king, you know. So anyway, now Richard's got to go. You'll notice that Richard is on holiday, so thank you very much for Richard for dialing in. And
Pleasure.
I will get to the macroeconomic bean counting.
Great. Well, Keith, thank you very much. And see you.
Okay, so 2 weeks time. So we're now entering the holiday period. I'm actually off next week, but we'll try and get something out the week up following.
Okay.
Two
Where
weeks
are you
time.
going next week?
Going to Colorado, mate.
Of course you are. Silly me.
Okay, on to the economic data. So quick summary, UK stagflation. UK GDP fell in April and is 1.2% year on year. Meanwhile, inflation's rising. EU, the same. US, actually strong nominal GDP growth. So inflation's rising, but GDP, the economy is growing absolutely just fine. So stagflation is not good for anyone, reminder. Best for commodities, worse for bonds. So UK, GDP for April down 0.1%. Disruption from the war, and year on year 1.2%. Not great. Bank of England consumer credit, stable. Mortgage lending, surprisingly good, actually, given the increase in base rates and 5-year yields. That is expensive to buy a house in the UK now. Net lending to individuals, stable. UK construction PMI, terrible. That is new lows. So builders are really struggling with reduced demand because of higher interest rates and increased costs. Halifax House Price Index down in May, also down in April, and only up 0.5% year on year, which means real house prices are falling, which is good news for young people. Indeed, job postings index still dropping. That is enormous drop, actually, and now a third below pre-pandemic levels. So if you're out of work, there aren't many job postings out there. Very bad for young people just entering the jobs market. Britain has the most complex tax system since the Napoleonic War, and that is not a good trend. Ed Miliband wants to commit the UK to cut its greenhouse gas emissions by a further 87% by 2040, which will mean more huge subsidies for renewables, which means your electricity bill is going to keep on rising. UK summary, basically stagflation, low growth, rising inflation. Onto the EU. So the EU So the ECB raised interest rates yesterday, and I'm going to read this out. The European Central Bank raised interest rates by 25 basis points at its June 2026 meeting, the first increase since 2023, as policymakers emphasise their commitment to anchoring inflation at the 2% medium-term target. The move follows rising energy costs and persistent inflation risk driven by the Iran conflict and disruptions to oil shipments through the Straits of Hormuz. The ECB stated the Middle East war is amplifying inflationary pressures and the rate increase is supported across scenarios assessing its impact on the euro area's outlook. The ECB also raised its inflation forecasts upwards, now expecting headline inflation to reach 3% in 2026 and 2.3% in 2027. It lowered its GDP projections, forecasting expansion of 0.8% in 2026, down from 0.9, and 1.2% in 2027, down from 1.3. So the ECB is forecasting stagflation. And This is the ECB's forecast for Eurozone inflation, and they're expecting basically a one-off hit. The GDP in Q1 was minus 0.2%. This is a revised second estimate, and that's bad, but it's not as bad as the headline suggests because that was entirely due to Ireland. And measuring Irish GDP is very difficult, apparently, because it's huge exports, imports and exports, and its role as a corporate tax avoidance hub, essentially. And so in Q1, the statistics show that GDP in Ireland fell by an enormous 12.1% due to pharmaceutical exports falling, apparently. If you strip that out, the bloc actually grew by a respectable 0.2 to 0.3%. CPI for May was 0.1% year month on month, which is actually not very much. So 3.2% year on year. So not that bad, actually. So in April, you had a 1% month on month rise due to oil prices. What it's saying is in May, there was very little further increase. So it's like a one-off inflationary impulse that is not leading to wider inflation as yet. Core is at 2.5, so actually not too bad. But when you look at the what manufacturers are reporting, they're reporting higher inflationary pressures. So we may yet see a bigger inflationary impulse. So this is producer prices, inputs rising at 4.9% year on year. Retail sales not great. April down 0.4%, up only 1% year on year. So Eurozone consumers not having a good time. The unemployment rate, though, is stuck close to its all-time lows. So slowly, it's taken, 2 decades, but unemployment in the EU has continued to fall. Loans to companies, 3.4% year on year. That's decent. Loans to households, 3%. That's decent. Money supply, 2.7% down, below expectations. EU construction, PMI bounced a bit, still terrible, and it's been terrible for the last 3 years, which is the length of this chart, and is the period for which data is available. So I think the best you can say is construction in the Eurozone is weak but stable. German Indeed job postings index still drifting down, not great. France, actually that is a bad chart, still falling in a straight line. This chart shows wages, real wages from 1994 to 2024, so the past 30 years in various countries, and Spain and Italy and Japan are right at the bottom here. Greece is not much better. Basically, the Eurozone has been a disaster for countries in Southern Europe. So, bottom line, pause, have a read, but stagflation. ECB is forecasting lower GDP growth and higher interest rates. And that's assuming that oil prices don't rise from here. On to the US. So we've had inflation figures for May, and they were bad. Okay, so in the EU, inflation in May was 0.1% month on month. In the US, it's 0.5, and inflation is 4.2% year on year, much higher than in the Eurozone. Core 0.2%, 2.9% month on month. When you look at it, actually, most of the components were pretty benign. Almost all the inflation is coming from energy. Now, we know that food will follow with a lag, but this inflation report was actually pretty benign. This is electricity prices. So AI demand is feeding through to higher electricity prices for US consumers, and that is bad for inflation. Talk about rising food prices. Well, I thought this was an amazing chart. This is US beef prices. So persistent drought in the Midwest due to climate change and the spread of New World screwworm has stopped herd rebuilding. And so beef prices gone through the moon. No wonder US software companies are making money. They've been raising their prices 15% year on year. But good news, last year we were talking about how US car insurance was a big cause of US inflation being too high. Well, finally stopped rising and in fact has started to fall. Producer price inflation, 1.1% month on month in May. That is not good. 6.5% year on year. Core 0.4%, 4.9% year on year. Still not good. Non-farm payrolls beat expectations at 172,000 in May. That's great news. Much better than expected. And you'll see after some weakness in the latter half of last year, the US economy appears to be strengthening again. And when we look at where the jobs have come from in the last 3 months, well, once again, healthcare and social assistance have been the main employer. Leisure and hospitality have also added a lot of jobs. Is that World Cup related? Question mark. You'll notice information technology, financial services have not been so good. Is AI destroying white collar jobs? Question mark. There's evidence for that here. So total private sector employment over the past 5 years has grown by 12%, but in professional services, white collar jobs, it's actually been falling for the last 3 years. Average hourly earnings 3.4% year on year, i.e. below inflation. US workers are going to be unhappy. Average weekly hours stable, 34.3, about normal. Unemployment rate not growing, stable at 4.3. The U6 actually fell slightly to 8.1. That's good news. JOLTS job openings saw a surprising blip upwards. Great news. So more evidence that the US job market appears actually to have bottomed. But hiring fell, quits fell, and layoffs rose, which is not really compatible with the job openings number. Some contradictory data. And when you look at small businesses, the survey of small businesses showed that hiring intentions fell sharply. So that would suggest a slowdown in jobs markets coming. Is the job openings and the non-farm payrolls number just a function of the World Cup? We're going to have to just wait and see. Challenge of job cuts rising, companies laying staff off, and number of companies saying they're cutting jobs due to AI has been steadily increasing year on year. Not good, not popular. Factory orders for April, solid, good. Inflation expectations in May actually surprisingly fell. So petrol and diesel prices stabilizing have anchored inflation expectations. This is the manufacturing PMI strengthening, and that's a good number, 54. Services, good number, 54.5 and up. So both saying the US economy is strengthening. So National Federation of Independent Businesses, i.e. small businesses, their business confidence index is slowly drifting off though. Not great. The RCM TIPP Economic Optimism Index, which is a survey of US consumers, drifting down. So Higher electricity prices, higher oil prices are having an effect on US consumer confidence. Existing home sales actually ticked up, but much lower than they were in this higher interest rate environment. Jobless claims going nowhere. That's a decent number. Continuing jobless claims ticked up, but that's still a good number. And Indeed job postings actually fell, so that rather contradicts the JOLTS number. Dallas Fed weekly economic index stable at 2.9. Atlanta Fed 3.3. That's a good number. New York Fed 2.7, strengthening. St. Louis Fed, which started off at like 0.5 and has been drifting up every time we report it. That's Q2. Lantern Daily Index has been rising again. Reminder, we talked about this last week, but it doesn't use daily data. It uses monthly and quarterly data, but reports them on a daily basis when they're announced. And it is showing the picture of US economy, which is strengthening. And reminder, it looks at nominal GDP growth. And so its current strength is also a function of rising inflation. Trueflation says there is no wider inflationary impulse in the US. That's good news. Now, we know that corporate profit margins have been widening and US corporations have got record forecast earnings, but they're not passing all that largesse down onto employees whose share of corporate profits have been falling. Labour not doing so well. Interest payments on the national debt as a percentage of GDP in the US are close to their all-time highs. And that's a function of higher interest rates and massively rising debt. That trajectory is absolutely unsustainable. The deficit needs to be reined in, but there's no sign it's going to be. Under current policies, the deficit is going to keep on widening. And the SARM rule, which looks at increases in unemployment, shows no recession in the coming year. So bottom line is, I think taking through that, the US economy appears to be strengthening. Now, how much of that is temporary and based on the World Cup, I don't know. But right now, doing absolutely just fine, going strongly. And quickly, some other economic charts that caught my eye. Look at this. This is Chinese chip exports. So anyone who is providing the US AI boom with hardware is doing incredibly well. Amazon will soon employ more robots than people. So you're looking at the purple bars. You see it been growing steadily, whereas the number of employees has peaked. And Amazon has announced it will be laying off more staff in the coming year. Almost 50% of US businesses now have a paid subscription to an AI company, but anecdotally, I'm hearing that a lot of companies have been unpleasantly surprised by the cost of the new AI models and are reining in their expenditure. Finally, good news. Okay, so did you know that black holes emit winds? So rather than just sucking everything in, some stuff gets back out, although that's misleading. So the winds do not originate from matter that has from inside the black hole. Essentially, what happens is as matter is sucked into the black hole, it releases vast amounts of energy, which create intense magnetic fields and radiation. And that energy heats up the surrounding gas field. And the gas then has enough energy to escape from the gas field surrounding the black hole. And it does so in the form of a high-speed, highly ionized cosmic wind, traveling at 30% of the speed of light, which is absolutely enormous. So this has been long theorized, but scientists at Northwestern University in the US have for the first time found evidence of these winds by examining the Sagittarius A star black hole at the center of our very own galaxy. So there you go. Black holes don't just suck in matter, they also emit winds at vast speeds. So concluding comments. Well, so the Iran war continues. Donald Trump is saying they're close to a peace deal. The Iranians agree progress has been made, but character saying they're not necessarily close to an agreement. And the final agreement remains distant due to excessive US demands. Now, my opinion is that Iran is going to keep the straits closed until higher oil prices force Trump's hand. So I expect the straits to remain closed, but disruption to the amount of oil leaking out through overland or other routes like through US convoys, etc., to steadily increase. But eventually, oil prices will have to rise because you can't draw down inventories forever. Meanwhile, the market's had a little bit of a wobble over the past couple of weeks, and I just think the expectations over AI are excessive. The biggest excess is in DRAM, where you've seen the performance of the Korean stock market, all due to Samsung, SK Hynix, etc., which produce memory chips. This is old technology. The margins used to be minimal, and they will simply add capacity, and margins in the medium term will return to not very good. In fact, there's unless if there is a fall in AI demand, then margins could well be even worse than that. So, at some stage, this bubble has to burst. Are we entering a topping formation? Question mark. I think so, but I've thought that previously. Richard thinks not. Anyway, be safe out there. Raising some cash might be a sensible decision. Okay, so we're now entering the summer period. I'm off hiking in Colorado next week, but we'll try and get something out the week after. In the meantime, thank you for watching. Please can you press like and subscribe to the channel. Let me know if you prefer the new format with the macroeconomic data at the end. I apologize once again for the length. Anyway, goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.